Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. I am really excited about the podcast today. We've got a fantastic guest, co-founder and CEO at LoanPro, and we're going to learn a ton about the lending industry, the auto lending industry, and how everything there works, and of course, why LoanPro is such an awesome company. So with that, Rhett, let me welcome you to the podcast.
Great. Thanks, Lex. Excited to be here today.
My pleasure in having you. So let's just set the scene about your journey into the space and into fintech and into lending. How did you start out? What got you excited about the space, and what were some of your early experiences?
Yeah, great question. So it's a similar story to many, that we built a tool within our own lending company that turned into software in its own business altogether. So, this is a similar story. You've seen it with Slack and MongoDB and DoubleClick, a whole bunch of services that they came out of a tool that was built out of necessity within an organization, and that tool turns into a business itself. So the very short summary is I did my studies at university in investment finance. And out of school, I decided to join my two brothers. We started an auto dealership, bought and sold cars. From there, that led us into helping our customers get financed. And so we started what's now known as a related finance company. And we really enjoyed the lending space. It was helpful we enjoyed letting our customers be able to finance vehicles, get into something that they were desiring to do. There also was just really fun on the lending side of things, of understanding not just the underwriting, but everything to do with the servicing on those loans. And we decided to scale our lending business and ran into a roadblock that the technology to run a lending core, similar to banking core, but a lending core, everything to do with the servicing of those loans, typically picking up at the point of decision through the rest of the life of the loan. So think of it as the operating system for a lending company or a bank. The technology was crazy expensive, hundreds of thousands of dollars, and was stuck in 1980. And it was just super frustrating to use it. They didn't have APIs. You had to use 3 or 4 separate services that were kind of stitched together very loosely, that didn't communicate with one another. So you'd have one service on an origination side do the calculations of a loan, ignoring irregularity of the first period. APR was wrong. The nominal interest was being printed as the APR, those kinds of things. And with the finance background, those just really bothered us, saying, hey, how can we scale our lending business with the core infrastructure and technology to operate that business on, being so problematic and not really the generation of tomorrow. So not intending to build out a software business, but instead as a tool for our own lending company, we built what now has turned into LoanPro. And that's really kind of the genesis of the innovation. Is similar to other stories where we had to solve our own problem, and it resulted in what's now LoanPro. Others reached out to us once we had this tool within our own lending company and asked us, hey, we're having these problems. What'd you guys do? Said, hey, we had to build our own software. Essentially, their reply was, I don't want to build software. Can I use yours? And for about a year and a half, we said no. This is a key differentiator for our own lending company. This is what we built. But after kind of groundswell of interest in saying, hey, I really don't think you guys know what you have here. We want to use it. We decided to say, why not? It solves our problem. Obviously, other lenders have this problem as well. And fast forward about 15 years, that's what LoanPro is at today.
That is so rich in detail and history that we're going to unpack a lot of it. But just for listeners to give a flavor, on your site, you've got over 600 lenders using the software, over $15 billion serviced, more than 3.25 million in terms of a number of loans. So this is really like an industry level software at this stage. Is that right?
Yeah, that's right. And when you're starting a business in the fintech space, there's a lot of work that goes involved in converting a tool into a full enterprise ready product, right? There's a lot of certifications. So we hold like a SOC 1, SOC 2, PCI, all those certifications. But there's a lot to it in the tech stack. We're fully cloud based, 100% architected and built on AWS. Those kinds of things are involved. We're approaching $1 billion a month in payments we're processing through the system. These are payments from borrowers back to the lenders that we're facilitating, and we're growing very rapidly. So you can check out our site to see the types of customers. But we've built a platform within the loan lifecycle. Since we're not focusing on the origination, we're picking up from the point of decision through the rest of the life of the loan. We've built a platform that manages loans across vertical. And this is something that's a key differentiator for us and kind of interesting in a nerdy way. We looked at this and said, okay, we started out ourselves in auto loans. But some of the early lenders who reached out to us did different kinds of loans. They would be factoring receivables or doing business to business or consumer or jewelry and so forth. And we really sat down and said, what's the difference between an auto loan and these other types of loans? And the conclusion was the channel of origination and the user experience during origination is the differentiator between the verticals. But after the loan is funded and money's pushed out the door, they somewhat standardize, about 80% standardize of how do you service and interact with a consumer loan for jewelry versus another type of loan. And it's based off the configuration of that specific loan account to the rules that guide how that particular account works, or what most would define as a financial product. What's the interest, and is it the frequency? Is it R over 365 or 12 equal periods in a year, or a whole bunch of settings? And so we built out a highly configurable system to manage loans across multiple verticals. And that gives us the ability to manage what look like very different kinds of loans, because we're really picking it up and we're managing everything in the lending core to do with the servicing side. So sorry, a little bit of a long answer there, but it gives a kind of a contextual understanding of why we work with lenders in these different spaces. And you can check out our site to see a lot of fintech and maybe neobanks or consumer lending or a lot of business to business. And that kind of explains how we're able to have a platform manage these different types of loans.
So there's a couple of things I want to open up here just as context. And you're going to do this later, but I think this is the right moment, which is, you've got Brex and Fundbox, which are two names that are familiar to me on your site as customers. And there's kind of a broader sector theme too. Like if you think about how did Plaid end up growing so much, and in part it was authenticating things for Venmo and riding on the rails of like a really widely adopted consumer tech, with Brex being kind of a widely adopted corporate card tech, huge growth embedded in that. Another example would be if you look at Marqeta, the payments platform, which lets you issue cards. They didn't really have the type of customer growth that's really well known now until companies like Grab got set up, which was after their founding, and so they ended up growing along with their customers once the market stars aligned. Is that what you're now seeing in kind of your business as well?
Yeah, absolutely. So our core thesis is that as financial services are democratized, everyone becomes a lender. And so we've sort of painted our corner of the universe to be the tech stack to enable anyone who wants to get into lending and allow them to stand that up. So our pricing model, our feature sets, the products, the core plus subscriptions, all of the things that are designed around that core concept you outlined, that we look at each customer as a partner of ours and we grow with them. And so our products, our features, our revenue, we're joining our customers in their journey of scaling and building out their financial products, similar to an embedded finance model, but this really enables whoever they are to bolt on lending. And we've seen a lot of interesting use cases happen here with maybe traditional finance companies, but more interestingly, non-traditional finance organizations that have built a large user base. And then they say, why don't we add these financial products to our customers they're looking for? That might be inside of an app or others, as well as you find the model with a lot of neobanks, for example. They've done a fantastic job of solving one of the core issues of a poor user experience provided historically by traditional finance companies or financial organizations. where they have a great user experience now in something like a Brex or a Chime or a bunch that have done a fantastic job of solving that user experience. But now the road to profitability for those organizations is through traditional financial products, but still keeping that same enthusiasm of the customer journey and customer experience. And so they'll be bolting those on. One of those financial services to be added is loans and variety of types of loans. And that's where LoanPro comes in, is to support the tech stack and the whole infrastructure to manage loans.
Gotcha. Just a quick follow up on that. Do most customers, or is most demand for like API embedding of this stuff, or is it still kind of private label platform or some sort of like SaaS platform that people log into?
Yeah, so there's a couple different users. Anything that's going to be customer facing or borrower facing, they're typically plugging into our API. The lender organization will control the user journey, right? So they have their own app, likely a stateless website or an app that's then calling, and the back end is LoanPro. And this is engaging with their loan, check your payment history, make a payment, see your balance, apply for a deferral, any engagement with your loan account. And then LoanPro, they're interfacing with our API to do anything tied to that loan. Another audience that's going to be interfacing with that same single source of truth is going to be the employees or the servicers of that portfolio. These could be employees of the lending company. It could be someone who's being outsourced to, or any form of combination of that. Typically, they're using the UI that's provided by LoanPro with the audience of the servicer to manage and interface with those loans. So a bit of a combination. We have folks that are embedding into our API, maybe a loan origination system or a website or an app or anything that's touching a borrower to maintain their user experience and control of what's happening, as well as other folks have found it the best benefit to use LoanPro's UI for everything to do with service those loans. This gets at one of the core problems in the legacy industry of financial services of data latency and multiple sources of truth. It's a big issue in loans. And if you go to one of the top 30 banks, they have an entire department that tries to stitch together multiple sources of truth. And it's a spaghetti bowl to keep that managed well. And it comes down to the core problem where they have separate operating systems, where you'll have a loan. Typically, you would underwrite or originate a loan, and then you'd hire a third-party company to service that loan. And if it performs, that servicer would keep track of it, engage with the customer, make payments, and so forth. But if that loan does not perform, they'll pull it from that servicer and assign it to another third party to do more aggressive collections, and sometimes repeat that up to 3 times. So now you have 4 system of record where you're not sure where your source of truth is. It's reasonably confusing to your borrower who they're supposed to pay to perform on their loan. And it becomes messy because each one has a separate tech stack, typically their own proprietary tech stacks to be dealt with. And so even if you go to some large banks today and you navigate on their website or the app, the data you're looking at has reasonably high latency in it. You're 1 or 2 days. You make a payment on your mortgage, and then you log into your app to see if your balance is impacted. It doesn't happen for a day or 2. What we've built is a platform that's a single source of truth. If it's coming through a website or app or an IVR phone system or whatever, all omni-channel, it's engaging with the single source of truth to do with servicing that loan. So it does a whole bunch of things of putting the lender back in control, but that's one of the scenarios of how it supports them.
Gotcha. So we raced ahead a little bit, and I wanted to lay down some foundational kind of just work on how this industry is structured. And I think there are many different lending industries. Like you said, there are many different segments, but maybe you could outline just in beginner terms for our listeners, what is the value chain and what are the technology solutions that exist at every stage, right? So we kind of talked about the distribution of lending product through digital footprints that are neobanks and so on. We've talked about, there's some underwriting software that exists somewhere. You've mentioned core banking systems, banking core systems like FIS and Fiserv. Can you talk about what is this jigsaw puzzle of stuff that comes together, and I guess like what does it make? Like what do people get out of it?
Yeah, great question. So instead of speaking broadly to all financial services, I'll focus specifically on loans, and it's a very similar answer across different financial services based off of its wealth management or other kinds. But in the world of loans, there's typically three that are involved. So the first is going to be a loan origination platform. This is where you source and acquire your customer. This could be engagement in an app or a website or a reseller site. A lot of these are embedded finance inside of a point of sale or checkout. The methodology by which you acquire or the customer applies for a loan. And then that data is submitted, and then there's some underwriting that happens. Typically, this goes through an apply, decision tree, a credit box, and an offer. That decision tree typically will go out and fetch data from a variety of third parties, use that data that it retrieves in a credit box and a decisioning tool to make offers of credit terms. And so LoanPro, we provide the workflow management for all of that that's encased inside of loan origination. But that's not what we typically market ourselves as. Our normal market is the next step, which is the loan servicing software or the lending core, which would pair directly here with like a banking core. And typically, banking cores are dealing with the other part of financial services: deposit, checking account, CDs, some investments, a few things. We've built out a really deep lending core about the loan management or loan servicing software. And so the step of the loan origination to find your customer, decision, and make an offer. And then inside of servicing, what we provide, this is everything to do with contracting, TILA disclosures, amort schedules. And then once that loan, maybe even moving the money to the customer, or if it's an indirect funding to whatever they're buying, maybe the merchant provider. And then the engagement with that customer, all of the compliance and any interactions and transactions with that customer, such as an assessment of fees or applying of a payment or scheduling an auto pay, or what if they lose their job and they need to change their due date, and you're going to change them from a monthly frequency to a weekly frequency, and you skip around where the days are at, the impact of how the math works on the loan for compliance reasons and so forth. And so you can imagine document storage, customer communications, as well as all of the compliance side of the audit trail and any form of transaction that's going to occur on the account. Let's say, for example, your company's policy is if your customer makes a payment of 95% of their regular payment amount, you want to go ahead and just move their next due date. So you're not going to keep a couple bucks to make them delinquent and have them negatively impact. They just missed it by a couple bucks, and so we're going to move it forward. And so that is a business decision and a rule to do that. You can implement that within LoanPro that based off of that rule and moving forward the delinquency on those accounts. And so an account's $2.10 that's past due. You say, you know what, we'll catch that up next time. I'm not going to count that as delinquency. I'm not going to forgive the balance, but we're going to go ahead and move forward your delinquency. That would be dealt as a transaction on the account, and we can automate that, as well as any kind of workflows. So in the space of consumer lending, there's a lot of compliance that's involved. What happens if the customer calls in or they show up on a list that they're active duty military, SCRA, and you're supposed to follow that kind of a process? What happens if there's fraud or there's a dispute or a whole bunch of different loan lifecycle things that can happen? How do you keep your company compliant and not require the person that your new employee who's engaged on a call center to know how the vehicle runs? You just want them to hop in and drive it. So we do all of that implementing inside of the loan and inside of what LoanPro provides. And the third piece of software is connecting into an accounting system. And so LoanPro can connect into, and we provide database access, we provide extensive reportings via the API where they can grab that information and collect it into an accounting platform. Between those three systems, essentially that's the entire back office of a lending organization.
Gotcha. Thank you for that. That makes a lot of sense. I come from the investment management world. So, I think of portfolio management and then trading rebalancing systems as playing kind of a comparable role. How does money movement happen in the consumer lending world? Like, how does one cause withdrawals? What do you reconcile with? Like, what about the write functionality rather than the read functionality?
Yeah, great question. So What we've done, and we were in the shoes of being a lender ourselves. And one of the difficulty is when you're lending, almost regardless of the vertical of who your customer is and what you're borrowing against, the lifeblood of your business is being able to move money around in payments. And so it's kind of scary and risky for a lender, especially in the non-traditional lending space. If you're not an FDIC insured bank or NCUA credit union, but instead, if you're going through another processor, it's very scary to go ahead and fully connect with a processor and have them own your payment profiles. The advantage of having them own and control and tokenize those payment profiles is it keeps you outside of the scope of PCI compliance, and you can offload that responsibility to them. The difficulty is the redundancy in payment processors. You're kind of getting hitched up to that processor for the long haul. So as a lender ourselves, we said, well, that doesn't make a lot of sense. We don't want to do that. We would like to have some redundancy in our payment processors and integrate with a standardized API with a library of processors. And so we built that system out inside of LoanPro, a product we have called Secure Payments, where we tokenize and save all the payment profiles, bank accounts, and bank cards under our PCI DSS Level 1 AOC ROC. And we tokenize the profiles there. And then we have a library of processors that we've integrated with that you can say, process this payment for $100. And here's the token that represents that payment profile. And then you tell us the ID of the processor that you want to run. And maybe that's running through one of our integrated solutions. And there's a couple dozen of list of processors. But then you want to run the next payment and run that through a different processor. We've enabled all of that. The way by which the transactions can get initiated, probably 90+% of our transactions, I think it's about 92.5%, are occurring from a feature within LoanPro we call AutoPay. When you board the loan, or at some other time somebody goes on the website and schedules up something to happen in the future, typically that's scheduling, pull my regular payment out. And so similar to a lot of other services where you schedule the system to automatically draft, those can pull from your bank accounts and your bank cards. There's a variety of other options we've done integrations with as well. There's been a proliferation of different kinds of wallets that are available out there, money in your Venmo account or money sitting in your PayPal account and various other kinds of wallets. And we've been working on some integrations to allow those wallets to pay in against your loans as well.
That's very cool. So I'm gonna just get two clarifying points. The first is that the tokens you're talking about are not the tokens that we're talking about in the crypto world. This is tokenized kind of information that is stored in an encrypted manner.
That's correct.
And then number two, just give what's a payment processor in this world? Like, can you give a couple of names?
Yeah, so a lot of people have built into here, so Plaid and a list have built out there. A lot of these are aggregators, so you can go directly to processors, Wells Fargo and Chase, and others that we've built into API integrations, including Notcha batch processing. And so there's a list, I think we've got about 27 that we're integrated with. Some have modern tech stacks, some do not, and we've built an API layer on top of and do Notcha batch processing for them. And so there's kind of the idea is you shouldn't have to know that under the hood because we've standardized the APIs and the processor so you can make it really clean to choose processor 1 versus processor 12. But those are a couple of examples of the folks that we're working with and that are involved in moving money around.
Gotcha. Okay, so we have a good flavor for the middle and back office industry structure, what it connects to, the component parts, what it does. And of course, it makes sense that this would be kind of like a maximally horizontal layer as long as it's well embedded into the different types of underwriters and so on. The other thing I wanted to chat with you about, which is the other part of your background, is the auto financing market.
Sure.
As you know, and your experience as a lender there, because that's not a market that we have spent a lot of time on, and so don't have a ton of depth. And I think folks would really enjoy learning more about that. Can you spend a little bit of time on back when you were in the dealership and standing up that business? What is the basics of, like, how does somebody make a purchase? How does somebody apply for
Sure.
a loan? Maybe some of the consumer psychology around that, and then we can kind of open that up into the broader industry dynamics.
Yeah, that's very interesting. I haven't been in that world for a little bit, but we have a very deep and intimate understanding building a technology supporting that world and then expanding to others. So the typical workflow is that a consumer will go to a dealership and say, I found a vehicle that I'd like to purchase. And usually there's three options at that point. They pull money out of their pocket and buy it. They say, I already have financing arranged with their credit union or bank or whoever, and they're going to bring you a cashier's check. So from the dealer's perspective, they paid cash, less a little bit of paperwork. And then the third option, which is becoming more and more popular, is essentially a point of sale financing option, where the dealer makes it convenient through a couple different platforms to fill out and get applied and receive financing there from the dealership. Typically, this is happening by the dealer technically writing the paper, but under the hood, the dealer already has an agreement with a third party company that's going to buy that paper, and they work out the terms. And so there's a variety of platforms. Cuddle's a common one for the lending space, but there's Dealer Track, and there's a dozen or so that are platforms to help market those loans and get underwriting, where different auto finance companies essentially are bidding to buy contracts. And this makes it very convenient for the consumer. So when you're sitting in the dealership there and they seemingly are taking forever, that's one of the things they're doing. It's not actually a technology reason why it takes a long time for you to wait. It's typically more of them, trying to get a warranty or something added on top of that, maybe get your licensing and registration done. But under the hood, when that loan's issued, for the first few moments, technically is that paper is owned by the dealership, meaning the consumer would owe the money to the dealership if they wanted to pay off. Within a few days, that paper is sold in the secondary market to, almost always it's prearranged, but to a lender. That lender would...
Sorry to pause you, but what are the economics for both sides, for the dealership and for those that are buying up the loans?
Yeah, great question.
What's the percentage on it? Yeah, what's the dynamics?
Yeah, it's a really interesting one. And what happens is there's the face value of the note. Let's do a hypothetical. You buy a car for $25,000. You've got good credit, so you're getting a 3%, 3.5% interest rate on a 60-month loan. The lender might say, okay, that looks great, but I'm not going to pay face value for it. I want to pay $24,000 for a loan that's face value of $25,000, and the consumer terms stay identical, but the dealer's willing to do that deal because they want liquidity and move on. They're in the business of buying and selling vehicles, not necessarily financing them. So that's called a discount, that $1,000, between the difference between 25 and 24 there. And it can go the other way as well. If the lender really wants it, they'll pay above face value. So it operates very similar to a bond, and it's just a single coupon all moved up front, similar to how the bond model would happen. And this is how almost every auto loan is happening when it's done from the point of sale at the dealership. They're involved in the dealer getting a premium or a little bit of a haircut or a discount in selling that paper. Sometimes the dealer, depending on if that paper is a paper or becomes less credit worthy, sometimes there's recourse associated with the lender and the dealer. So if the borrower does not perform on that loan based off of certain terms, such as if they miss one of the first 3 payments or 6 payments, then the lender can come back to the dealer and say, hey, this is your problem. You have to make me whole, and now you're going to buy the loan back from me. That almost never happens in prime paper, but it's pretty common with the creditworthiness decreasing. And as the lenders and dealers build out these relationships, they'll start to evolve into what the terms of the recourse might be. And so if you go to some dealers, they don't do that at all. And other dealers, 20, 30% of the deals they do, they're signing recourse deals on.
That's really quite interesting, the mechanics there. The underwriting decision on the dealer side, is that just like a FICO pull, or what goes into that?
Yeah, so essentially what happened is the dealer will do a preliminary review because they understand the decision tree and credit boxes of the different lenders they work with, so they know where to market the loan to. That's also what some of these platforms like Cuddle and Dealer Track do as well, is they market amongst them so the different lenders can bid on those deals. But typically there's a preliminary KYC or know your customer process that goes through. This can happen through, scanning a driver's license and doing a basic background review of a few things of fraud, as well as there's almost every auto lender is still using FICO scores. We're seeing a trend, just speaking a little bit broader, we're seeing trends in fintech of using things more than FICO. So it used to be that FICO was the primary determinant in information in making a decision, but now it's expanded to have many different contributing factors. In the early days of Facebook, when you were allowed to get metadata about the pictures, a lot of underwriters were taking that information based off of geolocation and saying, okay, they post this frequently on Facebook, and this is where the information is coming from, where the pictures being taken based off of the risk profile of how much this person moves around and tracking it. You can't get that information off of the photos now, but there's a lot of things, a lot of services out there that you're able to track, including a pretty popular one now of the ability to use Plaid or Finicity and others to look into a bank account and not just check your balance, but to check your history. Do you have a direct deposit in the account? What's the overdraft history? What kind of frequency are you engaging with this profile? Those kinds of underwriting parameters. So it's not just FICO. Auto lending still is traditionally using FICO, but they're starting to add additionals. Other verticals are moving fully away from FICO because some of the information involved in FICO is definitionally latent. And so you typically will get the performance of loans reported every 30 days. Well, if you're underwriting something that needs to be much quicker, then you need to rely on something like bank account history. Or if you're in the crypto space and you want to give a crypto loan, the primary thing you care about is your requirements for KYC. And then you're just caring about what cryptocurrency it is and how much you're going to lend against it. And you want the encumbrance on the token so you can call in real time if you need to do a margin call. So it sort of depends on the vertical, but in auto, yes, they're still using the FICO scores.
Cool. Okay. And then I guess one question is around the capital sources in these markets. Have you seen any evolution or any changes in the risk capital that is coming into, certainly into auto, but, and auto is a huge, huge market. And, I think fintechs had trouble getting there, but increasingly that's changing. But even more generally, in terms of the flows that you're seeing through your platform, is there any shifting in the type of risk capital that is coming after interest rate yields?
Sure. So there's so much money right now. There's everybody seeking yield. There's a bit of insecurities in what's happening in the equity markets. People are not thrilled with the yield they're getting in the bond markets. And so what we found is a huge amount of money is flowing into alternative investments, including loans or portfolios of loans. Auto or anything that's a collateral based that has mobility and is highly liquid with higher sticker prices is hugely desirable. So if you've got a job of deploying $1 billion, it's really interesting to you to lend that against something that is, maybe sticker price of $30,000 to $50,000 per deal. You get a pretty good yield on the return that you're getting of individual deal. But if the customer doesn't pay you, it's highly liquid. You can roll it through the auto auction. You repossess it, roll it through the auction. Because of the supply chain issues today, used vehicles at auction are selling for often more than what you can get a pre-order that's on back order for a new vehicle because of supply and demand. So the existing portfolios are performing very well. There's some hypothesis about what will happen with ones that come further down the pipeline. But if you have an existing auto loan portfolio, you're killing it right now. You're doing fantastic. You have high liquidity. There's also a lot of performance that's happening with customers doing very well and making payments on these loans. And so auto is very attractive. We see others that are also slightly less liquid, but still very attractive of heavy equipment financing. Tractors, trailers, those things. We have several that use us for ATV, UTVs, those kinds of collateral-based type loans, trailers, and other things in that way. Typically anything that you can have a title on. We also have a lot that are in the point of sale financing that we're seeing sort of a ridiculous amount of money flowing into Everyone's interested in the buy now, pay later space. And if you're going to go start a fund and you're going to invest in buy now, pay later, you're going to find a lot of competition. There's a lot of capital seeking a buy now, pay later because they have pretty good yield. And that's similar to the model I described on the auto lending side happening with the discount and the retailer. And so almost universally, the consumer on a buy now, pay later is getting a 0% interest loan, typically 4 installments. If they don't perform, some of the products start accruing interest, others just have fees. There's a diversification of what the products look like, but many of them are 4 installments, 0 interest as long as you perform. Well, a lot of the capital providers are buying that back of book and getting a pretty good yield on those. So we see a huge amount of money flowing into these loans. From the space that we're in, we see volatility in the equity markets push more money into the loan market that's happening.
Super interesting. So there are two macro changes or events that are just kind of worth pausing on for a second that you've articulated or that maybe we've just discussed. And those two are the capital environment, the finance world of the capital markets that have made interest so scarce, and that it's led to asset inflation in equities, asset inflation in crypto, and sort of not a lot of good debt that's yielding stuff. And so you go looking for debt that's yielding stuff, and you want it to, ideally, or at least for some particular risk profile, you want it to be collateralized by a thing, whether that thing is a car or a bunch of, ETH in a box on the blockchain. And so that's the macro financial environment. And then you've got the sort of macro fintech environment, which is really flattening out the technology stack in such a way that it makes sense to have a really efficient horizontal technology solution for, this is the system for lending, this is the system for wealth, this is the system for investing, and then let's plug that into not just into financial distributors, but also into ecosystems, into the car dealership that you've described, right, at the point of sale, into home improvement. I mean, BNPL, I think is an interesting aside because there's some strange payment dynamics in there. But regardless, you've got like this confluence of these two macro themes. If you were to roll time forward, and certainly I'm sure you do strategically with your company, but if you were to roll time forward and say, look for the endpoint of these trends. How do you see them changing and scaling out the way that you do things? But even more importantly, how do you see the shape of the industry and the shape of the markets transform around that?
Yeah, great questions, and thanks for articulating that. Both of those we see and we monitor and we're involved. On the first point about additional capital going into these markets, and if you're an investor, you're seeking yield. It's very intriguing where if you're giving a collateral-based loan on some collateral that is appreciating with fairly high liquidity opportunity, then you almost don't care who you're underwriting, right? You're willing to say, sure, I'll give you a loan because if you don't pay me, the asset that underlying it is going up in value. And so what we're seeing is this is one of the contributing factors to this cycle we're seeing of inflation happening, because as we increase the depth of financial inclusion, there's more parties that are involved and more folks who are willing to lend to those parties, and more people are participating now and driving that demand side. And so we're seeing that across a bunch of different verticals. Certainly you see it in real estate. We see it in consumer-based assets. These might be auto, they might be jewelry, they might be crypto, where we're seeing this be one of the contributing factors that's driving the inflation is the increase of financial inclusion due to the concept that the underlying asset is increasing in value and there's high liquidity available in the marketplace. To the second side of things, what do we see as the technology enhancements enable more folks to participate? The way we look about this is look back to the Wild Wild West here in the history of the United States. And back then, your local mercantile store would be where you would have credit, and everybody would have credit there. And you'd go in and buy whatever goods, and you'd pay them based off of the cycling of when your cash flow happened, often with the crops. And then the lenders came in, and there became a consolidation of those lenders to almost some national brands that were giving those lenders, and some platforms and networks that were enabling local lenders through a national brand. Think of the credit card networks. But then there's it's been kind of a moving back to say, okay, well, why isn't that mercantile store providing credit? They used to, and then they said, okay, I'm not in the credit business, I'm in the business of selling things. And now they're trying to flirt with, should I be offering credit again? So to your point, yeah, there's buy now, pay later. There's always been layaway. There's been for others, but we've seen airlines that get into the business of their employees that are always in airports and they're having difficulty with financial services. So they have a credit union. And within that, they now have an app of the credit union for the airline employees. And now they make it easier for them to get loans. We're finding employer groups or payroll processors or, other organizations that have a large user base saying, well, why am I doing direct deposit to your bank account for your payroll? Why wouldn't I issue you your own free checking account and a debit card within my network? That way I have 100,000 employees. If I do your direct deposit to your company bank account, if you so choose, and I give you a spiff to do so and encouragement to do so, then if you spend with that debit card out of the bank account that we're controlling, then we get the transaction fees. And so there's some efficiencies there. All of that's being enabled by the technology advances. Where LoanPro comes in is the supporting of anything to do with a loan. So if you're dealing with a neobank that's doing a spot me type of loan or an advance to avoid a fee, or if you're working with more efficiencies in better priced products. And the way we're coming at it is saying, by providing these features and the tech stack to enable all of these lenders to get into the space, meeting the needs of their consumer or customer better, this is bringing down the cost of capital as we get more competitors in the space, but also as we have the existing players in the space have more performant portfolios. So a big area of our focus is to do with the loan servicing. And as you're aware, there's a huge amount of energy and effort and money that's spent on loan origination and the customer's experience during acquiring that loan. But after you get the loan, I think every consumer can feel that the enthusiasm drops off and you have to fax in documents to places, or you got to call 10 times to get a hold of somebody. And it's just frustrating to be engaged with them. Well, that's what we're solving, is the tech stack for the lender, so that that same enthusiasm during origination can continue through the rest of the life of the loan. And this is resulting in more performant portfolios, happier customers, cross-sells, upsells, and with the lender focusing on their existing customer base instead of just on the new customers coming in the door.
Yeah, I mean, I have a very personal experience that I can identify with here, which is, I had a chunky loan for my grad school, and that was originated through the university and then refinanced through SoFi. And it was a discombobulating experience because, the SoFi interface is really fresh and nice, and they sure want to sell me some credit. And you refinance, and then you're booted into, like you said, a fax system just happened to be rendered in the web with a SoFi logo, in the wrong color in the corner. And you're like, that's very strange, because when you're using a bank or when you're using a brokerage or a wealth manager, you don't have this very obvious separation of system and incentives. And so kind of it's very intuitive that the space is in need of a refresh, and the stuff that you're doing is fantastic. Let me ask you, if our listeners want to find out more about you or LoanPro, where should they go? Social media accounts, websites, things like that.
Sure, yeah. You can check me out on LinkedIn, and it's important to me in the ecosystem to be a contributor. So happy to engage with you there. And then also for LoanPro, our website is loanpro.io.
Awesome. Really enjoyed the conversation and learned a ton. Thank you so much for coming on.
Thanks, Lex. Appreciate your time today.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.